revisit a couple of things from the syllabus and the schedule. So I'll pull those up from Blackboard. They're posted, the course syllabus and the schedule. So first of all, I wanted to remind you that the 2 lowest homework grades will be dropped from the overall calculation of your homework average. And I've implemented that on Blackboard. I didn't turn it on until there was at least more than 2 assignments because it would look really weird in the way it calculates your average. But it's switched on now, and so what you see is your average with the 2 lowest grades being dropped. Now later on, if you have a lower grade than one of the ones that's being dropped now, the system will automatically pick whichever is most advantageous for you to keep. So it'll drop the lowest score. Then the other thing I wanted to point out is that there's a link here in the syllabus to the form that you should fill out if you're going to request a university excuse for an absence. If you're going to be absent from class, there's no need to email me or mention it to me or contact me. You can just go directly to the Office of Student Affairs. And the reason why I follow that approach is that there was a semester a couple of years back where in the same semester I had one student tell me that they were going to a funeral. I found out later they were actually on vacation. And then another student tell me about some really intimate medical problems that I just definitely did not want to know anything about. And so I just decided from then on that I didn't want to be in the position of, being the judge of whether an excuse was valid or not valid. It was just easier if I left that to the professionals in student affairs. So by filling out that form, then it can all be sorted out. They'll contact me once they've approved it, and then I'd make the adjustments in the grade book as necessary. Then the one other thing I wanted to point out is that here on the schedule is basically a list of topics that we'll cover each class meeting. And so, for instance, you've got homework 6 on your plate right now. If it seems like there's a couple of questions on the homework that we haven't covered yet, you can look at the list of topics and see when we'll cover certain things. And so on Wednesday, for example, I mentioned that the first 2 questions on the homework you could cover from Wednesday's information, and then the next 2 problems you could cover based on what we'll go over today. But if I forget to mention things like that, you can always go to the course schedule and just kind of sort out when different topics are going to be addressed. So are there any questions related to the syllabus or the schedule? All right. Now, Monday, homework number 6 is due at noon. So you should submit it to Blackboard. And I think in this particular assignment, you're going to need to turn in both an Excel file and a PDF. And so I'll ask you to follow that same approach of writing your answer to the question on paper, even though you've solved a problem in Excel. And then in the Excel file, go through that process of annotation, which is where maybe you're writing notes to explain your thinking, you're highlighting certain cells that have maybe the final answer. And so rather than just it being a page full of numbers but not really answering the question that's being asked, do everything you can to show your thought process and make it easier for the homework grader to understand where your solution is. Okay, next in the list of announcements, Wednesday of next week is the Career Expo. And I'd love for you to be able to attend that. And I know that some of you have a full day of classes on Wednesday afternoons. So what I'm going to do is I'm going to put our class meeting online that day. So we won't have a live class meeting here next Wednesday. Instead, you should just watch the recorded lecture video, similar to how I posted the lecture video when I was out of town, those class meetings. So you can go to the Career Expo. I think it's going to be a great opportunity for you to meet employers and hand out your resume and maybe check in with people who you've worked with in the past. And I wouldn't want anybody to miss that because they've got uninterrupted classes. And then the final announcement, I'm just going to keep mentioning this, even though it's not anytime immediately due, but the project submission deadline is Friday, November 17th. All right. One other thing, I've made pretty good progress on grading the exams. I think it's likely I'll be able to return those to you on Monday, and then we'll also go through the solution together. I'll probably paste if I do finish grading the exam over the weekend, I'll put the grades on Blackboard. I mean, if you're really anxious to see what you did, keep refreshing Blackboard all weekend long, and maybe at some point your grade will post there. And the reason for that is that DF midterm grades are due, the university needs them by Monday at noon. And so I'm going to do everything I can to have the course grades reflect the midterm exam before I report the midterm DF grades.
So homework's going to be due Mondays from here on out?
No, I wouldn't necessarily say that. I'd say they'll be due on the dates that are indicated on the schedule. So it may coincidentally be Mondays. Looks like, yeah, from here on out, oh, here's a Wednesday. Yeah. Yeah, the homework deadlines mainly just align with what I perceive to be natural breaks in different topics. So, you know, when we finish a certain chapter or there's a certain technique that I've finished showing you, then that's more of how I align the homework due dates. Any other questions before we move on? All right, so today we're going to cover two closely related topics. How you can calculate something which we'll call the unrecovered investment balance, and how that same analysis can be used to help you understand a process known as amortization. So this material comes from chapter 7 in your textbook, and I hope that most of you are checking in with the book from time to time, because you know, it's one thing to come to class, and I'm glad that you do, but the majority of your learning, I think, is going to happen outside of the 50 minutes that we spend together 3 days a week. I think that you're actually going to learn when you practice certain techniques, when you solve the homework assignments, when you read the book. So I think the more time you spend thumbing through the book, then the better off you'll be. All right, this is a picture of a food truck. And I think I saw some sort of an email announcement about a food truck event on campus.
Bonfire.
Is it today? There was I think a food truck event that's being held across the street, if I'm not mistaken, like at the Playhouse or something. But
Something like that.
yeah, there's a really vibrant food truck scene in Portland, Oregon. I went there a few years ago for a conference, and there was 2 city blocks full of nothing but food trucks. Probably like 70 or 80 food trucks. It was really interesting because, you know, it's one thing to build a building and have a bunch of seating, and, you know, there's a lot of startup expense with that, but it allows maybe more fringe culinary ideas to get a foothold if the investment isn't quite as big. You know, a food truck maybe would cost a lot less than a building and seats and taking out a long-term lease on a certain location. So I tried some really fringe things when I was in Portland that time. I came to really love Georgian food. And I don't mean like Atlanta, Georgia. I mean like the Republic of Georgia. And boy, they really have unique cuisine. And I got so interested in that food that I ended up going to Georgia for about 2 weeks a few years after that. And I've never eaten so well as I did in the Republic of Georgia. But let's just take this example of a food truck that serves hot dogs, which I think would fit right in Huntington. Huntington loves hot dogs. So let's say, what if the average food truck costs about $85,000? And I found that through a quick internet search, that when you take into account the vehicle and the kitchen equipment that you have to have inside of a food truck, and you know, getting it painted and refurbished, and of course there's other costs as well, like permitting expenses, the food itself, the employment. But if we just look only at the capital cost, let's say there's an investment of $85,000 that's needed. And let's say that you live someplace where people are just really loose in their spending, and that they're willing to spend $8.50 for a single hot dog. That seems a little high to me. I think sometimes, has anybody here ever been to Hillbilly Hot Dogs down on Route 2? It's a fun place to visit. I always thought that their hot dogs are maybe a little on the pricey side, but they're a lot less than $8.50 each. But let's say, what if you're going to be making $8.50 each? How many hot dogs do you have to sell to cover the food truck? Well, I think you know by now the level of sophistication that you've got with the time value of money and thinking about cost. It's not just as easy as dividing $85,000 by $8.50, because number one, this $8.50 includes the cost of the ingredients and also the cost of the labor required to produce it. So only a fraction of that $850 is going to be able to go towards covering the cost of buying the food truck. But then in addition to that, and maybe more importantly, there's the issue of the time value of money. That is, you borrowed the money at time zero, where dollars have relatively more value, and you're going to be recovering money in the future. And because of inflation, future revenue doesn't have as much value in today's terms. So if we wanted to answer the question, how long is it going to take to pay off the food truck, then one of the ways we could do this analysis is with something that's called the unrecovered investment balance. And we could, on a year-by-year basis, look at how much revenue came in that year, how much of the revenue go towards debt service, how much interest accumulated during each annual period of our payment, how much of the payment goes towards principal, how much goes towards interest, and then over time we could watch our loan balance decreasing. Now this analysis that we're going to do, it works regardless of whether you're borrowing money from a bank and you want to see your debt decrease over time, or if you just used your own personal dollars and you're not financing it with a loan, like if you're using money that you already had and you're investing it into this project, what this technique shows you is when do you have all of your money back that you had invested into the project. So there's really not much that we need to do to change the analysis depending on our perspective. It's just we have to be aware that if we've borrowed money, this process calculates one thing, but if we are ourselves the investor, it's just representing how long until we get our own money back rather than how long until we've paid off the loan. So any questions so far? This illustration comes from the textbook, and I think it's important for you to be able to understand what's happening in this diagram well enough that if needed you could tell the story of this figure. So for example, if you had a future scenario where you were asked to summarize this figure, maybe like in a test or something, could you do it? I think this is a really important figure to be able to explain, so I'd like you to be able to describe in your own words what's happening. So I'll do my best to explain in my words what's occurring. So we start off, let's just say that we've used our own money. We had a pile of cash and we went and bought that food truck. It was $85,000 and that was our initial investment. And we did that purchase at time zero. So this line is up because if you look at the label of the vertical axis, it says unrecovered investment balance. So unrecovered means how much did you not get back yet? How much have you not yet recovered? And your investment is that money that you put into the project to begin with. So initially, $85,000 went out of our pocket, and almost immediately you'll notice that the unrecovered investment balance is increasing. So this blue line represents during the first year how the balance is increasing. Anybody want to speculate on why would the unrecovered investment balance be going up during the first year? Interest. That's right, because if that $85,000 that we had, if we hadn't put it into this project, we could have done something else with it. We could have put it into a money market account or a CD. We could have bought treasury notes. We could have done something else with it. And so there's some interest rate that represents our opportunity cost. The other thing that we could have done with the money if we didn't buy the food truck. And so that opportunity cost may influence what is our minimum attractive rate of return. So the point is there's some interest rate that we need to take into account. The interest rate that we're taking into account could reflect the effect of inflation. That could be what we use to guide our interest rate. But however we look at it, there's some interest rate, and when you've got money out there in the wind, you know, you've bought equipment, haven't got any revenue yet, the balance is increasing. So interest, compound interest especially, never sleeps. It's always accumulating. So at the end of the first year, how much is unrecovered is the initial investment plus the interest that had accumulated. Now let me just pause for a moment and talk about time. 0 on this axis represents the beginning of when any money changed hands. So that is a point in time. You'll notice that these numbers aren't at the tick marks like I usually sketch them. Do you notice how the number 1 is between 0 and the first tick mark? Normally, when I'm drawing a cash flow diagram on the board, for example, I'd have 0, 1, 2, 3. So when the number is next to the tick mark, I'm representing a moment in time. This is at the end of the first year, what I'm representing on the board. Now, in this figure, what do you suppose 1 is referring to? It doesn't mean the end of the first year. What does it mean?
The first year, or period year.
It means the entire first year as a period of time. So, when does the first year start? At what instant does the first year start? Time 0. On this diagram, when does the first year end?
At the end of the fiscal year.
At the end of the fiscal year, at the end of the first time period. Now this is confusing, but when does the second year begin? At what time does the second year begin? On the board here. So this is, we call this the first year. So the first year went from time 0 to time 1. When does the second year begin?
The end of year 1.
At the end of year 1. So at time 1, like if we call this instant of time, like where the tick mark is, this is time 1, which we know means the end of the first year. So the second year goes from time 1 to time 2. So the second year is from the end of the first year till the end of the second year. I know it seems like I'm getting fixated on a point of trivia here, but it'll be important when we set this up as a spreadsheet because we're going to keep track of time a little bit differently than we have before. We're going to be talking about the first period, the second period, the third period, and we're not necessarily going to keep track of time in the same way that we have in prior Excel cash flow diagrams. It'll be just a little bit different, but it's not hard. You just have to recognize that the first time period is from 0 to 1. The second time period is from 1 to 2. The third time period is from 2 to 3, and so on. So you can prove it to yourself just by doing a little sketch. Does anybody have any questions about this clarification on time? Okay, so at the end of the first year, the balance is high because of the effect of interest. But then there's this arrow pointing downward, and what it does is the arrow is bringing down our unrecovered investment balance. And here to the side of the arrow, it's saying that the magnitude, the length of this arrow is R1 minus E1. So what that means is it's the difference between revenue and expense. So think about when you sold a certain amount of those Rucky Chucky hot dogs, that would be your revenue. Subtract out the expenses. So subtracting out the ingredient costs, the cost of labor, any fees that you pay to the city for health permit or licensing and registration, insurance, fuel, and so on. So you could think of it as the profit. How much money is left over from operating the equipment? That goes into your pocket and it brings down your unrecovered investment balance. So it is the difference between revenue and expense that justifies the initial outlay of cash. If the revenues didn't exceed the expenses, you wouldn't be in business. Like if a Rucky Chucky hot dog costs you $10.50 and you're only going to sell it for $8.50, that's not sustainable and you wouldn't start the project to begin with. But if there's a spread between revenue and expense, then maybe this business could be sustainable. So it brings down the unrecovered investment balance. Now, why is it that the arrow is all at once? Well, that's the end of period assumption, which we talked about earlier in the semester. The end of period assumption just says that let's assume, for sake of simplicity, that we aggregate all of our inflows and outflows that occur during a period, and we express them at the end of the period. And so as a single arrow, we get all of our revenue, all of our expenses are tallied up at the end of the period. Maybe the period is a month, maybe a period's a year, but we tally it up. We see where things stand. We had an excess of revenue, so it brings down the unrecovered investment balance. And so now we're below where we were at time zero. That's good. Things are headed in the right direction. After a year of operation, we have some of our unrecovered investment balance back. So this trend continues over time, where during each annual period, the unrecovered investment balance goes up because of the effective interest. We have some profits that bring it down. The unrecovered investment balance goes up, the profits bring it down, and the trend continues. You'll notice here this little dashed mark, the squiggle, that just represents that there's some additional years, the passage of time that's not necessarily depicted on the diagram. So after n years, finally the unrecovered investment balance comes down to zero. So when the unrecovered investment balance is down to zero, that means that you've achieved break even. You've gotten enough money back to economically justify the initial unrecovered investment balance that you'd paid to purchase the equipment. And then hopefully this equipment can continue to be used even beyond the break-even point, in which case you'll experience more profits above and beyond the minimum attractive rate of return. So a couple of notes here. The first year is from 0 to 1. The second year is from 1 to 2. And the labels that are shown here are indicating periods. And this same sketch could be put together whether you are the bank and you're thinking about, I gave this person money to buy a food truck, or if you are a borrower and you took money from the bank to purchase the food truck, you could think of this as your loan balance. Because at the end of each month, you'd be paying a certain amount to the bank to cover the loan, and the loan is gradually working its way down to zero. So that's amortization. Or if you were an investor who had purchased it with your own funds. This same set of calculations can be applied either way. Now, we've talked about internal rate of return on several occasions now. Remember that the internal rate of return is the interest rate that brings balance between the inflows and the outflows after a certain period of time. So at the internal rate of return, you'll achieve break even, or a zero unrecovered investment balance at the end of the study period. So sometimes you have to solve for what is the interest rate that brings balance between the inflows and the outflows. And so in a lot of problems, you're trying to calculate the internal rate of return, like we did that on Wednesday. But today, we're going to be looking at something different. And before we get into the in-class exercise, let me just tell you a little bit more about amortization. The Latin root of amortization is mort, so death. It's the same root as like mortician or mortal. So here I've got the Grim Reaper because in this case, what the Grim Reaper is killing is our debt balance. As you make payments over time, the payments are the same. You'll give the bank the same amount every month or every year, but there's a calculation that can be done that shows you how much of that payment is going towards principal and how much of it is going towards interest. And we'll do a calculation like that today in our example, where there will be a breakdown between how much of a payment is covering the principal, how much is covering interest. And so you've got a homework question that asks, actually you've got two homework questions that you're going to use this process on. And the same process can be used for unrecovered investment balance as calculating how a loan works its way down to zero over time. You can use the same column titles in either approach. So amortization is normally thought of as the action or process of reducing or paying off a debt with regular payments. There's an alternate definition that's sometimes used, which is related to writing off the initial cost of an asset. In our class, we're going to more typically call that depreciation. So I think that there is a distinction between amortization and depreciation. But if you put the word amortization into Google and search for definitions, you may see either of these. I think that the way that the word is used most often refers to a gradual reduction of debt. And then just to clarify the distinction, we sometimes talk about depreciation as the gradual reduction of an asset's value. All right, so let me give you this handout where we're going to calculate unrecovered investment balances. And I also need to put a template file onto Blackboard. Let me do that now, in fact. Hopefully OneDrive is working. Yeah. So I'm just going to put it in the main root of our directory here. So this is the ICE 17 student start file. So that'll be there in just a moment. Let me upload it here. All right, so if you see it, go ahead and open that template file. It's an Excel file, and if you open it, it'll save you the trouble of having to format the spreadsheet. I've already done the formatting that I think will be useful to you. All right, let me hand out these papers. Okay, so you can tell from the problem statement, the first part of this you're going to just solve by sketching out the cash flow diagram and using the table lookup factor that I've provided.
Sorry, it's supposed to look like yours right now.
If you use the equation method, then you should always report your answers to the nearest penny. And so that means you shouldn't round off at all when you're using the equation method. And so in your calculator, you should keep all of the precision of the factors that you calculate. And if you're given a factor here, like you're given a factor with 1, 2, 3, 4, 5, 6, 7, 8, 9 digits that are shown, that means that your answer can be reported accurately to 9 significant figures. And so in this case, we've only got 1, 2, 3, 4, 5, 6, 7. So that means that this penny, we do accurately know that it's going to be $19,093.30. So this amount, the $19,093.30, is something that you're going to use in the spreadsheet template that I provided. Now, the other thing I wanted just to point out before I pause for a moment and let you jump into the spreadsheet is, like the cash flow diagram here, this is still the cash flow diagram, even though the unrecovered investment balance diagram would look more like what is shown here. So this isn't the cash flow diagram. This is a diagram of unrecovered investment balance. So if the problem asks for the cash flow diagram, like this one does, what you're illustrating is that you got $85,000 at time 0, that you're going to make 5 equal payments, and the interest rate is 4%. And so until we've calculated the value of A, the cash flow diagram should just label it as A is unknown. Okay, so down here at the bottom of the table are the formulas that apply, and it kind of gives you hints on how to use this table. So I want to see if you can figure out, based on the column titles and the formulas that go along with the column numbers. So like, for example, it says column 2 you should calculate by I times what is in column 1. So there's the first year, the second year, the third year, the fourth year, the fifth year, and so on. So let me pause for a second, give you some time to figure this out, and then I'll also show you the solution after about 10 minutes. Okay, so our interest rate here is 4%, so I'll put 0.04 into I. Okay, unrecovered principal balance beginning of year 1. So 85,000. Now, it says in the problem that you receive $85,000 from the bank. So that's how much you haven't paid them back yet. So I'm not going to put negative 85,000. Like in my mind, I just know that from the perspective of the bank, they haven't yet recovered 85,000. From my perspective, I owe 85,000 and leave it at that. So 85,000 is at the beginning of the year how much I've taken out. Okay, so interest this year on the unrecovered balance. It says the formula for column 2 is I times the amount from column 1. So I'll refer here to the interest rate. And since I'm going to drag this down into other cells, I'll use the anchoring F4, or you can type the dollar signs in manually, times 85,000. Okay, so if you borrow $85,000 per year and the interest rate is 4% per year, you owe $3,400 in interest for that year in particular. So the balance of the loan at the end of the year, just before the payment, is the unrecovered investment balance plus the interest. So this $88,400 is like, what I'm referring to is this point in the figure where the blue line has taken things up, like the balance has gotten even bigger because of interest, and we're about to make some sort of a payment that'll bring it down. But for now, our unrecovered investment balance is even larger than it was at the beginning of the year.
How much you put together for that one again?
This one is 85,000, so it's column number 1 plus column number 2. Everybody with me so far? Are there other questions? Okay, so how much do you give the bank? Well, we calculated that at the beginning of the problem. It's $19,093.30, right? Let me increase the number of digits that I'm showing just so I can see the cents. And that's going to be the same for all of the years. So let me drag this down, but I need to pay special attention to make sure it's not counting up with the numbers, because sometimes Excel will increase it by 1 for each row. So you're going to give the bank the same amount every year. All right, now, if you are going to, of this $19,093, if $3,400 goes towards interest, then the principal is how much of the payment didn't go towards interest. So the payment has 2 components. When you give money to the bank, some of the money you give the bank covers the interest on the loan, and some of the money goes towards the principal. And it's not the same with each payment. Initially, more of your payment goes towards interest. And it's not because banks are diabolical. I mean, although they are. It's just because at the beginning of a loan, your balance is higher. And so more of your payment is going to go towards interest when your balance is higher. So it's not like they've somehow schemed and arranged things to cheat you. It's just a natural consequence of the fact that your balance is decreasing over time. Okay, so we've got the unrecovered principal balance at the beginning of the year. So then the end of the year, if you look at the formula here for column 6, it says 6 is 1 minus 5. So column 1 was the unrecovered principal balance at the beginning of the year. And now we subtract out how much of our payment went towards covering the principal. So at the end of year, our unrecovered investment balance is $69,307 and 70 cents. Okay, so we've gone through 1 year. Now, the end of the first year is the same point of time as the beginning of the second year. See this point of time right here, this dot? That's the end of the first year. It's also the beginning of the second year. So whatever amount that we have as our unrecovered investment balance, I'm just going to use the equal sign. Equals and point at this location. Because the end of the first year is the same as the beginning of the second year. And we don't have to type in the formula another time. For this, we can just drag it down. And you can see that your interest is lower during the second year. Why is the interest lower? It's because you have a smaller balance at the beginning of the second year. And so the balance of the loan just before you make the payment is going to be the sum of the beginning of year balance plus the interest that accumulated. So this is how much you owe the bank just before the payment. Then you make this much of a payment, of which some is interest, some is principal. How much of it is principal? In this case, now the principal in the second year is $16,321. So then the unrecovered investment balance at the end of the year will be same process as before. It's the beginning balance minus the amount that goes towards principal. And we can continue this trend through the rest of the spreadsheet. I think we can just drag this, all of it down. Like if you highlight all of the cells and drag them all down at the same time through the rest of the spreadsheet, it gets awfully close to zero. Oh, it's doing that counting thing. See how it says 1993, 94, 95, 96? Let me just go ahead and override that so it's the correct amount each year. Sometimes Excel has a mind of its own. All right, we get down pretty close to zero. 3 cents is our balance, and that's because with 5 years we couldn't have made a payment of fractions of cents. So the way that we know that we've solved this correctly is that at the end of 5 years, the unrecovered investment balance is down to zero. You can use this same process on your homework.
So should we count it as being correct if it's less than $1 after a certain time?
I wouldn't want to say $1, or, you know, it depends on the problem. It's problem specific. Yeah. Okay, so you use this same approach for problem 3 and problem 4. Problem 3 is almost an exact duplicate of what we just did. Problem 4 is very similar. So make note of the fact, though, that on problem 3, it's talking about monthly payments for 3 years. So you'll have 36 years that you need to do it for. Since Excel is doing the calculations, it doesn't matter if it's 36 years or 36,000 years. Once you've got the formula set up, it'll just do the rest of the work. All right, that's it for today. I'll see you in class on Monday.